all of us are huge believers and huge enjoyers of stablecoins, and all of us have a deep belief in open and transparent financial markets. What we've seen in the past is that there's different vaults where, first of all, the underlying strategy is not even publicly stated. So literally, you're handing over your funds in a black box, expecting returns to come out of it. That works as long as nothing happens. What we tend to do at Steakhouse is really focus on high conviction bets and master them and dominate there. Funnily enough, we are the only curator that wasn't affected directly or indirectly by stream finance. Two other curators are completely wiped out since then.
In 2026, the most important financial infrastructure in crypto isn't a token, a flashy chain, or even a trading venue, but a vault, with its programmable structure that governs risk, transparency, liquidity, and yield, all on chain. Today, I'm joined by someone who has spent the past few years turning that idea into reality. Hannes Detlefsen is a chef at Steakhouse Financial. This company is where he and his team design and deploy vaults that serve everyone from power users to institutions, fintechs, and even custodians. Hannes, welcome to the show.
Thanks for having me, sir.
So let's start with your background. What drew you into the DeFi space and what was the leap into Steakhouse like?
Um, so I've been in crypto for a couple of years now. I never did anything else, so all my professional life has actually been in crypto. I couldn't be more happy about it, to be completely honest. What drew me to crypto back then is I was always super interested in business models that are internet native. And when I came across crypto, I really saw this kind of intersection between game theory, macroeconomics, technology, but also all of the ethical background of it, just like creating open and permissionless financial infrastructure for people that are, for example, currently unbanked, underbanked, or just want access to financial products that are not available to them right now. Um, and when I then came across crypto, mainly Ethereum back then, funnily enough, I actually skipped Bitcoin and went right into EVM and Ethereum. I was amazed by the concept of smart contracts, decentralized applications, and mainly like decentralized finance. Um, then I gained some professional experience, some experience in a startup. Then I was lecturing in multiple formats across Germany, mainly, and the German speaking audience. And then I joined the Deutsche Börse Group to actually be responsible for their on chain strategy. Um, and then spent 2 years at Deutsche Börse Group, where we then launched the multilateral trading facility for crypto assets. It's actually the first one in Europe that's completely institutional. Um, and then after spending 2 years in a heavily regulated environment like Deutsche Börse Group and really getting to know how traditional finance works, but also looks at digital assets, I was super interested in actually seeing the other side. And that's what drew me into DeFi, basically, where I had my personal roots and where I was most interested in, and actually making it a reality that I'm also doing it full time. Um, and that's how what led me to Steakhouse. I've seen the overall positioning as Steakhouse. Steakhouse is one of the most knowledgeable firms that are out there. They have a great name. They made a great name for themselves with a background in MakerDAO, um, advising multiple stablecoin issuers after that, and then basically starting the overall curation meta or on-chain asset management meta. Um, and just like whatever we will speak about today is really what drew me into the space and let me commit full time into this.
What's the internal philosophy that is basically driving the way you build?
Um, Steakhouse is a stablecoin first company. So all of us are huge believers and huge enjoyers of stablecoins. And all of us have a deep belief in open and transparent financial markets. Most of the company is really coming from a traditional finance background. We got people from Goldman, we got people from JP Morgan, from huge consultancy firms. Me personally, coming from Deutsche Börse Group. And all of us have experienced one way or another how the traditional financial markets work today. And all of us share the core belief that there's value in actually trying to build a new financial system on public blockchains. Um, and what we really believe in is that decentralized finance should be as decentralized as possible. Everything should be on chain, everything should be immutable, as well as completely transparent and non custodial. And that's the philosophy that we have. And the bottom line of any product that we build is really customer first, which means that we really look how can we bring the most value to the client, and especially in crypto where you have a heavy VC base that might screw the incentives from time to time to actually just build short-term products that not necessarily bring value to anyone. Our philosophy is building long-lasting value and really bringing value to the end client. Um, and being a fully bootstrapped business without like VC capital, we can actually make that a reality and are not forced to do all kinds of stuff that maybe heavily VC-backed companies must must do just to basically serve their investors.
Great answer. A lot of listeners hear vault and imagine something abstract, right? How do you define a vault in plain language? And why are they foundation to stablecoin based finance?
Um, so what a vault can be many different things. If you really abstract any complexity away and seek a parallel in traditional finance, then it would be like an exchange traded fund. So like an ETF. Whenever you buy an ETF right now, you basically have a one-click experience and all of the underlying strategy is abstracted from it. So a fund can represent, I don't know, the S&P 500, which is basically a weighted index, but it could also be a highly levered position of some kind of index. So, for example, a levered ETF on MSCI World or whatever. A vault is really just a vehicle to make strategies that can be extremely simple and highly complex, accessible to a broader client base through a one-click experience. Um, and it will really be the enabler how we can onboard the masses to decentralized finance because the user experience is still a huge bottleneck today. Um, and that's really just what a vault is. So it's really if you were to see given a analogy, then it would be exchange traded funds on a public blockchain. However, they're fully transparent, fully non-custodial at all times, and fully automated.
Like, do you code yourself? Or
Yeah.
are you, yeah, yeah, yeah. So it's it,
Like there's all the vaults follow the ERC 4626 standard. That's literally like an ERC 20. What Steakhouse currently mainly is known for is the vault curation of repo markets. When we're referring to repo market, it's really over collateralized crypto lending. Um, Mainly focusing on Morpho for now, which is basically a pioneer of modular lending infrastructure, where you really separate the risk management, risk curation from the underlying technology. Um, that's repo. We've been mastering this. We currently have around, I think it's 1.8 billion of TVL in those repo markets. However, what we've seen is that there's demand for strategies that go beyond this over collateralized lending. That's where the other three pillars come into play. Um, when we're speaking about the carry trades, it's really just the idea of borrow low, lend high, and monetize on the spread. There is just assets in crypto markets that are where if you were to rely on repo markets, they would be kind of underserved. For example, the demand for Bitcoin in repo markets. So the demand to borrow Bitcoin is extremely low. just because the kind of strategies that you can do with it, or like the reasons why you would borrow Bitcoin are kind of limited. For example, if you were to borrow Bitcoin right now, most likely you would want to short it. However, if you were to short Bitcoin, there would be way more efficient methods available out there to actually do it. So that leads to the fact that Bitcoin is literally whenever you lend out Bitcoin on chain, you maybe get, I don't know, 25 to 75 basis points for it, which is really not a lot if you think about that you would have to wrap your Bitcoin, you post it in a smart contract, and then you basically got smart contract risk, Oracle risk. And like for 25 basis points, I'm not sure if it's a viable product. However, what we now do with the carry trade strategies is that we post the Bitcoin as collateral, borrow against it for, let's say, 3 to 5%, and then invest the borrowed amount into a higher yielding strategy. You obviously can't do it with the full amount just because of the volatility of the underlying Bitcoin. That's why we start at like 10%. And depending on the risk profile of the respective client, we can also go to 20 or 30%. And we basically monetize on the spread. So we borrow at 3% or at 4% and invest those kind of USDC into your higher yielding strategy, earning 10%. And that's the carry trade strategy, which basically aims at crypto holders that have, for example, it's the same for ETH, by the way, that have huge amount of BTC sitting somewhere or huge amounts of ETH sitting somewhere, don't want to rely on the repo rates only, but are interested in more kind of active strategy. And that's whom we want to serve with this kind of product. Um, then the next one would be the term strategies. So we spoke about repo before. The interesting thing in crypto repo markets, or to say it differently, traditionally repos overnight. Um, However, in crypto markets, literally the loans that you actually create technically have the duration of a block. So they could be repaid anytime, and you really don't have any certainty of how long this loan will actually be open. Obviously, there's different mechanics that we will also speak about later. But what we introduced with the term products is actually twofold. So right now, having in mind that all of the loans have the duration of a block, technically, um, DeFi came up with the concept or with a protocol called Pendle, where actually yield bearing assets are split into two tokens. So you got yield tokens, YTs, and principal tokens, PTs, where the PTs actually represent zero coupon bonds known from traditional finance. So you have the ability to actually lock in a fixed rate for those kind of assets, um, and they come with an illiquidity premium. So either what we do in this kind of strategy is that we invest in different kind of PT tokens, and because they have a different kind of maturity, but you want to have liquidity at specific amounts and at specific points in time, we will actually create a strategy where the maximum duration is around 6 months, but the average maturity is around 60 days. So we play around a little bit with different kind of Pendle PT tokens in order to capture a higher yield than just like lending against it. However, that comes with drawdowns in terms of liquidity. So there can be points in time where there might not be liquidity available, even though you have the ability to um, pull out your funds anytime. It's basically a function that you can call, which is called force deallocate. However, you might incur slippage doing that. Um, that might be just a little disclaimer on kind of the risk. And then the last one that we spoke about is looping or leverage. Um, a huge amount of the overall activity in DeFi markets today is actually looping. So you got a yielding asset. It's exactly what I described before. You got a yielding asset. You borrow at a cheaper rate and basically lever up the trade. An example would be you deposit a yield-bearing stablecoin yielding 8%. You borrow a you borrow USDC against it for 3%. You sell the USDC, you buy more of the yield-bearing stablecoin, you post it as collateral again, and loop that trade up, and basically take leverage on the spread. Um, all of this taken together is just like building blocks for strategies that we can create. And depending on the client profile that we serve, we can basically take those pillars and tailor the respective investment strategy to the client. Um, and we try to come up with a simplified framework for that, just because many people in crypto or in finance in general try to overcomplicate things to basically underscore that they're the smartest in the room. We're pretty confident that we're also um, pretty smart. However, we want our investors to really understand what's going on under the hood. And that's why we try to break it down as much as possible to the core building blocks that actually are part of the underlying strategies.
In preparation for this interview, to be fair, I checked the website and the documentation that you guys posted. This is amazing. Not everyone, far from that, actually, there are quite just a few companies and organizations who do it with such a detail, but at the same time, we're in such an understandable manner. That's I think what can also differentiate you. Can you break down the trade-offs between different vault-based products? What's happening under the hood, as you frame it?
Um, I would say the problem lies in the fact that a vault can represent all kinds of strategies. As explained earlier, it could be anything from just, I don't know, repo, simple repo against blue chip assets to, I don't know, a highly leveraged strategy. What we've seen in the past is that different kind of vaults have different levels of transparency of the underlying strategy and take different amounts of risk. Um, However, if you just view it from a high level, you just see, hey, there's a one-click deposit vault, it's yielding X%, and you basically would most likely shoot for the highest yielding one because you don't even see the risks. And from time to time, the risk is also not really explained, or like the underlying strategy is not really explained. What we've seen in the past is that there's different vaults where, first of all, the underlying strategy is not even publicly stated. So, literally, you're handing over your funds in a black box, don't even know what's happening, and expecting returns to come out of it. That works as long as nothing happens. However, usually, if there's, I don't know, if the market turns or if there is a liquidity crunch event, you actually see what was going on under the hood. And in the aftermath, it's like, yeah, we should have known it in the first place. Vaults can largely differ in first, the strategies, but second of all, also the trust assumptions that you take. For example, at Steakhouse, we really build our products with a high degree or with the highest degree possible in terms of transparency, non custodiality, and limiting discretion. However, there's many other vaults out there where literally there is a vault curator or fund manager in that sense that literally got full control over your assets. So it would like the best analogy I can give you there is I transfer $10,000 to your MetaMask account and just say do whatever you want with it. And there's literally a range from something really basic, like our Morpho Prime vaults, where we basically say, hey, okay, the strategy is repo, and we provide liquidity to blue chip markets only, which is literally BTC and ETH only. Um, but it can range to we take your funds, we transfer them to a centralized exchange, and we do leverage trading on Binance. And it's literally the whole spectrum. And for most of it, DeFi users are not asking enough what's actually the underlying strategy, what's the counterparty risk that I'm taking, and what are the trust assumptions. And that's how vaults can differ. And when basically thinking about what I would like to give to the audience, is just do your due diligence first. Check if there's actually transparent reporting on the website. Check if there's information about the underlying strategy, and also on the underlying strategy. Like, it's not that, for example, we in the recent months or even years, we had a lot of strategies building on top of funding ARP. However, even with funding ARP, there's a lot of risks involved. What happens if you get ADL, for example? What happens if there's a centralized exchange involved and the centralized exchange gets hacked? It's just there's so many risk vectors that are not price um, in those kind of vault products, and that really makes the difference. So bottom line is really what kind of strategy um, the respective vault actually inherits. And the second one would be what kind of discretion the fund manager has. And is it actually non custodial, or are you transferring your funds to a non regulated crypto hedge fund?
What are the design choices that matter most for partners who are building yield products with Steakhouse?
Steakhouse has positioned itself as the institutional partner of choice, mainly because we really come from a DeFi angle. So we build all our products non-custodial, which means that also the institutions that are integrating with us don't have any counterparty risk because it's really smart contract based. And even if all of us would die in a plane crash or decided that we want to act maliciously, we wouldn't be able to. That works, and now I'm referring to the Morpho vaults mainly. That works through kind of the governance that surrounds a Morpho vault. So there's different roles in a Morpho vault. There's the owner, there's the curator, there's the allocator, and there's the guardian. Um, Whenever we set up the vaults, we literally act as the curator, which is responsible for actually proposing an allocation strategy based on repo markets. It would now be what kind of markets we actually want to provide liquidity to, and if there's any boundaries in terms of how much liquidity we can direct into each individual market. If we wanted to introduce some changes, it's subject to a 7-day time lock. And within that 7-day time lock, there's actually the guardian that has the ability to veto any decision that we propose. Um, Now coming back to why institutions are choosing Steakhouse in the first place is that we really come to them, look at what they're actually trying to achieve with the respective product that they're looking for, what their client profiles might look like. So is it more, I don't know, do you have clients that are actually risk seeking and not afraid of losing part of their capital in the worst case? Then we might be able to provide, for example, a leverage strategy. However, for most of our integrations right now, it's really that the products are super simple. It's literally, as mentioned before, the Morpho Prime vaults, where we only expose the clients to lending in an over collateralized fashion against blue chip collateral, um, which effectively represents the risk free rate in DeFi. Um, and the ability to really tailor the product to the institutional client, and also having a white glove service whenever clients come to us and might not even know in that moment what they actually want. Us picking it up and acting as something which is more than only a curator, but literally someone that supports them in the overall life cycle of introducing that kind of on-chain product, makes our service pretty valuable and made us the institutional partner of choice, in my opinion.
Let's stop for a minute. For those who may not know me,
My name is Nasib Fathi. I'm a scientific researcher in the blockchain space, and I'm a growth and media professional working with executives and organizations. My focus is crypto at the intersection of institutional finance, market structure, and regulation. You are watching the NFK podcast, where these topics are explored through conversations with people shaping the future of digital asset space.
Your partnership vaults span Coinbase, Safe, Farcaster, Ramp Network, and more. What does it take to make DeFi infrastructure usable by major fintechs and custodians?
It really depends on the kind of fintech that you're working with, as well as the regulatory dimensions that you have to keep in mind. What we've seen with the integration with Coinbase, where we are the exclusive earn provider, is that nowadays you can really integrate those kind of on-chain offerings into your main application while adhering to the regulatory frameworks um, that you actually have to follow. So how Coinbase solved it is really that they, within their main application, introduced self-custodial wallets where there is no gas fees, where there is no private keys, and where the client really doesn't even know or doesn't even feel that he's interacting with a decentralized application. All of us know it when they use their MetaMask, say, or whatever. It's extremely poor UX still. After so many years in crypto, it's literally still the case that you need gas on any chain that you want to interact with. If you get BTC, you have to wrap the BTC to in order to do anything with it in DeFi. What Coinbase did is really abstracting away all the complexity. You literally hold, for example, if you want to borrow against your BTC, you get BTC within Coinbase. You click borrow against that BTC. In the background, they will actually pledge that BTC in their custody, mint CBBTC against it on base, and then post it as collateral or Morpho in order for you to draw the loan. On the other hand, for USDC, it's literally they say, "Hey, do you want to lend out your USDC?" And you basically press on lend, and in the background, the USDC moves from the Coinbase custody in a self-custodial wallet, and from there in the smart contract of Morpho. Um, and for you as an end user, you don't feel anything of it. But what enabled, um, or what is enabled through this kind of product is actually that Coinbase now has the ability to benefit from permissionless capital aggregation on chain, which means that their lending product is so scalable that they could have never achieved it with their internal lending desk. And anyone can come in and provide liquidity to the Coinbase users. It's pretty amazing if you think about it, especially if you think about it in a way that the end user doesn't feel it at all. Um, that's something that we've seen over and over again within the US, but also within the EEA. That those kind of embedded wallets, which are usually provided by either Dynamic or Privy, that those kind of embedded wallets where you have the ability to basically plug and play on-chain applications while abstracting away any complexity are getting more and more relevant and allow heavily regulated institutions to actually provide access to on-chain applications. That's one part. And then the other part would be the high modularity and the tailoring of the actual underlying strategies that you want to expose your clients to. I think the combination of those, so that you have a highly modular infrastructure that you can actually build around the way how you want to design it, and we act as a technology provider, plus the ability to actually provide the access to this tailor-made application that you just created without creating any friction for the end client. It's just an extreme game changer, and we will see all of the major institutions that currently have a crypto offering offering these kind of embedded wallet plus DeFi access products within the next 12 to 18 months.
Interesting. And Steakhouse is active on Morpho, as you mentioned already, and Camino. You're very deliberate about what you integrate. How do you evaluate platforms and decide where to build?
When looking at the vault curation or overall vault ecosystem, you can see a lot of vaults that are kind of deploying everywhere and trying to be as broad as possible from the coverage. What we tend to do at Steakhouse is really focus on high conviction bets and master them and dominate there. Which is also the case why we are currently only active on Morpho as well as Camino. It's really that we have to be comfortable that it's a project or protocol that has long term value and long term upside, as well as also getting in at a good point in time. So, for example, for Morpho, we've been there right from the start. And if you're there right from the start, obviously you benefit a lot from the growth of the respective protocol. Same for Camino when they actually introduced the vaults on top of their existing infrastructure. And then obviously we just have to be comfortable with the smart contract architecture with the respective team and then take it from there.
What's been your biggest learning from co-designing vaults with partners who are coming from traditional finance space?
It's actually an interesting question also from for me coming out of traditional finance myself. I think there is still a lot of education to do when it comes to bringing TradFi and DeFi closer together. Um, just the idea of decentralized finance can be quite hard to grasp for many of the financial market players right now because like literally all that they've been used to is that you concentrate the financial services as much as possible in the hands of trusted intermediaries. Um, the educational task now lies in the fact that you say, hey, even though this might be cannibalizing part of your business, it can also be a huge opportunity if you have the ability to actually adapt to it. And we will see a lot of financial institutions that will not necessarily be disintermediated, but just will have to change the kind of product offering that they serve today to a more crypto native and on chain product offering in the future. And it really starts with education. The second bit is also making them comfortable with decentralized financial market infrastructure. Um, Sometimes it's just hard to grasp for them, I think. However, with explaining the different concepts to them, making them comfortable, and also, as I mentioned before, tailoring it to what they're actually interested in. For example, I don't know, if they're worrying about KYC AML risks, that we have the ability to also whitelist participants that have the ability to actually interact with those kind of smart contracts can be a huge enabler. Same for the risk profile, um, and same for the underlying protocols.
Is the biggest blocker to institutional adoption, to wider institutional adoption, still regulation is, or is it product design?
I would say we solved the product design for or a big part of it as at least, just because of the high modularity I just mentioned. So nowadays you can really pick the kind of strategies that you're interested in, tick all the boxes from a KYC AML perspective, and really build a product that you're confident with. So I think from the product design itself, it should really be solved by the kind of infrastructure that we have today. On the regulatory side, there's still a lot of blockers. So let's say it like that: the more traditional the company gets, the more blockers are there from the compliance team. When we look at the institutions that we're working with together, the easiest kind of integrations are non-custodial wallets. Then there's centralized exchanges. Then there's retail brokers with a crypto offering, or like crypto native retail brokers. Then there's retail brokers with a crypto offering, neobanks. And then basically here would be traditional banks, traditional financial market institutions. I would say regulation remains the biggest roadblocker, mainly KYC, AML, the permissions nature of many of those protocols, commingling of funds, and just the worrying about what happens if I have a liquidity pool and North Korea interacts with it. However, if you're actually looking at the on-chain data and analyzing it, you would see that it's literally close to zero, especially in repo markets. It's just something that these kind of actors not really participate in. And as said, many people also just don't know that we could ring fence if there's the need for it.
Steakhouse rates lending markets based on asset, platform, and market quality. What does that process look like in practice?
That process is kind of what makes us as a risk curator extremely valuable in the first place. So you can think about it of on Morpho, anyone has the ability to create a market, which basically means you define a base asset, you define a collateral asset. So, for example, you come up with USDC and BTC. So you would be able to post BTC as collateral, and you would be able to borrow USDC against it. Then you define a interest rate model, which is currently only one on Morpho. Then you define the interest rate model, you define the respective collateral, and you define the loan to value, max loan to value. That's how you spin up a market. And technically, everybody will have the ability to deposit into those markets directly. However, um, how Morpho is structured is really that instead of individuals depositing into the individual markets, the capital gets pooled at the vault level, and then there's professional risk managers that evaluate the different kind of markets and evaluate what markets we should provide liquidity to. Um, when we're looking at what we can onboard as collateral or as markets that we potentially provide credit against, it's really, as you said, based on three kind of categories. The first one would be the asset where we really it depends on what kind of crypto asset it is. So it can really be a spectrum starting at like a native crypto asset, ERC20, like a governance token. And on the other side of the spectrum, there's literally a tokenized private credit fund with a whitelist. It's really a spectrum of assets that we potentially provide capital against. But if we're looking at the asset itself, we're looking at it from a lens of what is somebody actually holding if they buy that asset. So, is it a stable coin? What's the backing of it? What's the governance of it? Is there any multi-sigs involved? If yes, what's like the threshold? Is it a 2 out of 3? Is it a 5 out of 8? Is there any DAO governance involved? How big is the asset? Who are the founders? Are the founders involved in any kind of scams that happened in the past? It's literally a fully fledged DDQ, which is bigger than most of the KYC questionnaires that I've seen in traditional finance. And then to come back to your question, and then there's the protocol risk. That is mainly like relevant when, for example, you have panel PTs. So it's not only the asset that you're actually looking at, but there's a protocol in between that splits the asset in two, and we basically have to be comfortable with the all involved protocols um, of the respective asset that we want to onboard as a collateral. And then at last, there's the market risk where we have to check, okay, do we have our oracles that can provide um, the right value of the respective collateral at any point in time? Is there enough liquidity on chain to actually liquidate a position? How big can the position get in order to be able to liquidate without actually accruing any bad debt? And all of this goes into our evaluation process. Um, all of the different categories get a rating, And depending on the end result of the rating, they can either be um, placed in the prime bucket or in the high yield bucket, or are not available in any product at all. And to be completely honest, most of the assets that we're looking at and that we receive inbound from are not available for any of our products. So we're looking at many, many different products, and most of them are not hitting the threshold of being um, suitable to actually serve as some kind of collateral in our products.
How do you think about the balance between yield and solvency?
It might be worth to actually state what kind of risks we're mainly looking at, and that would be liquidity risk as well as solvency risk. Liquidity risk basically stems from the fact that there might be moments in time where the vault is not liquid, so a depositor wouldn't have the ability to withdraw the full amount of his capital that he deposited. That's just um, it just stems from the fact that morpho markets target a utilization of around 90%. So think about there's a vault with $100 into it. The ideal scenario would be that $90 of it are lent out at any point in time, and you have the ability to draw $10 at any point in time. If you were to draw the $10, the utilization and $90 are lent out, the utilization would spike to 100%. The interest rate would increase based on the interest rate model, and the borrower would have the incentive to actually repay his position. Which means, bottom line, that there can be moments in time where all of the liquidity is lent out, the rates spike, and then over time, liquidity flows back into the vaults. That's the theory. In practice, for our prime vaults, we never had any point in time where there has been illiquidity in our prime vaults. Um, and we only had like time frames of a couple of minutes where it happened in our riskier high yield vaults during the stream finance incident, where basically nobody knew how far this blow up will actually spread across the system, and all of the people basically just pulled out the funds of the vaults. And there we actually had some kind of illiquidity. However, for the lender, it really doesn't change too much because the rates will spike. If you're at 90% target utilization or 90% utilization, um, the or let's say differently, if you're at 100% utilization, the interest rate is 4x of what it would be at the target utilization of 90%. So therefore, the only thing that you're getting as a lender might be a small time frame of illiquidity, but you also get compensated a lot for it. Um, where the bigger risk lies is actually in terms of the solvency. And the solvency risk is really kind of like the biggest risk, and what also comes down to our collateral underwriting process and what kind of markets we onboard and stuff. It's really about the fact, is there always enough collateral at any specific point in time to actually make the lenders whole? And if you onboard collateral um, that might default at a specific point in time, thinking about, I know that we will speak about this later in this episode, but thinking about a yield bearing stablecoin, and you basically got that yield bearing stablecoin, somebody posts it as collateral, pulls out, I don't know, 90% of the value against it in USDC. But all of a sudden, the yield bearing stablecoin completely goes bust, goes to zero. Then there can be the case that actually the borrower doesn't have any incentive to repay. And because the whole DeFi is completely anonymous or pseudonymous, it basically means that you will never see the capital again. And the collateral that you thought is securing that kind of position is actually worth nothing anymore, which means that the lender will not get whole. And that's the solvency risk. And now coming back to your question, what's the correlation between yield and solvency risk, I would say higher yield always comes with higher risk. That's just like a basic formula. Um, and the risk constantly gets underpriced in crypto.
Okay.
So you really have an inelasticity of the risk premium in DeFi, which basically means that even if you're increasing the risk by a ton, it doesn't necessarily translate into a way higher yield. So, for example, if you're looking at more for repo markets today, there's different kind of offerings, and maybe there's, I don't know, a spread of 100 to 200 basis points between different kind of vault offerings. However, the amount of risk that you're taking is like a completely different risk profile, and it just like doesn't get priced um, in the correct way, in my opinion. However, when we're actually speaking about how yields and the solvency risk correlate with each other, I would say the yield and the risk that you're taking are not necessarily correlated one to one. And the risk constantly gets underpriced in DeFi markets. But there's definitely a correlation between the yields that you're getting on your respective strategies and the risk that you're taking.
Steakhouse expends significant resources to underwrite even low default rate crypto repo markets. What's the part of the risk curve you think most vault users underestimate? For example, credit, counterparty, or collateral volatility.
If I had to choose one, it's really counterparty risk. Um, it really builds on the information that I stated in the previous questions, where it's just there's many products out there where the end user really doesn't know what kind of counterparty risk they actually take. And it can be as simple as the issuer can unilaterally change something on the token, can mint an infinite amount of tokens, um, or there is like no real governance behind it, or it's an undisclosed backing in terms of like a tokenized hedge fund. It's really, I would say it's mainly the counterparty risk because everybody thinks, hey, it's DeFi, hey, it's crypto, and therefore it's basically trustless, permissionless, and everything is on chain. It isn't. And there's a lot of products out there where one or two persons could unilaterally change the overall protocol. And I think that's a risk that many folks are not aware of, and that's like not true DeFi.
Can you walk us through your risk mitigation system and strategies?
So, when speaking about our risk management, we really try to mitigate as much risk as possible upstream by actually doing a proper due diligence on the collateral assets and doing a proper underwriting of those. Um, and then, whenever the vaults are set up and the collateral markets are onboarded, it's really about constant on-chain monitoring of multiple different vectors, a high degree of automation, and also about processes whenever there is really something that happens on chain. So to keep it really short, it's really a combination of a proper underwriting process of the collateral as well as 24/7 on-chain monitoring and automated processes around it.
How did the stream finance blow up in 2025 that we mentioned teach the industry, and what changed in how you approach both safety afterward?
I would say it disciplined a lot of DeFi users. It's funny in DeFi that things always are taken to the extreme before the people realize again what really this market is about and what is a good investment and what might not be a good investment. Um, for us at Steakhouse, what we learned out of it is really to stick to our underwriting. So core philosophy of what Steakhouse is doing is really no shortcuts on collateral underwriting, no backroom deals, no token incentive deals, and really stick to the plan when it comes to we have a due diligence questionnaire. If they're not passing the questions, we won't do anything with them. And there can be billions of borrow demand against that kind of collateral asset. If we're not confident with it, we won't onboard it. Funnily enough, we are the only curator that wasn't affected directly or indirectly by Stream Finance that has like a major TVL. Actually, two other curators are completely wiped out since then. And another one is still around, but definitely also took a hit. For us at Steakhouse, it's really just sticking to a risk management process, maybe providing lower yields from time to time, but also creating products where the client can be sure that there's actually someone that does proper risk underwriting and will never deviate from that.
One of the less discussed risks in DeFi is the liquidity trap,
Yeah.
where utilization gets too low and interest rates fail to pull capital back in. How do you evaluate the market for that risk before allocating bold capital into it?
How we deal with that is really twofold. So one is whenever we create a new market, we basically seed it in a specific way. And that's just a result of how the interest rate model of Morpho markets are built. So basically, there's strategic decisions being made whenever we're setting up the markets in order to basically, before we allocate any major capital to it, that we seed it with capital and create a good baseline of where the yield should actually start before creating the organic market. Second of all, is actually that we have caps on our reallocation bot that's running where we also ensure that there is no liquidity provided whenever the yield falls or like the borrow costs fall under a specific threshold. So, for example, if you are scared of the liquidity trap, we basically just say, hey, if the borrow rate in this market falls below 2%, pull out liquidity or don't provide any additional liquidity. And that's how we ensure that there's never the situation that the interest rate falls so low that there's no incentive for the borrower to repay. And when looking at the interest rate model of Morpho, that can be a situation where actually you don't seed the market correctly. So therefore the interest rate starts at, I don't know, 25 basis points, for example, at the kink level of 90%. So even at 100% utilization, the interest rate would only be 1%. And then over time, the overall interest rate curve would actually move higher, but it takes some time. So there will be a time frame where a borrower has no incentive to repay, even though the utilization is at 100%, and the client can't pull out his funds at any time. And for us, it's really just like seeding the markets correctly and being and mastering the interest rate model of Morpho.
Mhm. What advice would you give to the other teams designing vote level permissions today?
I would actually push for full transparency. So whatever can be on chain should be on chain. And then to actually stick to the core beliefs of decentralized finance, which is strong non custodiality. When we're looking at especially Morpho vaults today, we see many vaults where there's no proper guardian in place, which means that essentially the curator is acting as the guardian as well as the owner. And then you're again just transferring ownership to someone that could unilaterally um, do whatever he wants. In our vaults, what we do is that we actually create a mini DAO out of the depositors that are representing the guardian. So it's even more direct than in monolithic protocols like Aave, for example, where you have a DAO that's basically governed by the token holders that are not necessarily the depositors in the protocol. But how we create our vaults is really we have the depositors in the vault, and you get a pro rata share on the actual governance of that vault. And we create the guardian as a checkpoint that actually can veto any decisions that we propose at any point in time. And that's really the basis of the strong non-custodiality of our products. And if I were to really point one thing out, then it would be stick to the core principles of decentralized finance and actually build decentralized products.
We often talk about stablecoins as payment infrastructure. You're thinking about them as an investment infrastructure too. What's the opportunity space there?
I think the biggest opportunity stems from the fact that, from a regulatory perspective, most of the stablecoins are first required to have a one-to-one backing in either deposits or HQLAs. And second of all, don't have the ability to pay out yields for now. However, what you see and what is completely rational, in my opinion, is that whenever you're sitting on a good amount of stablecoins right now, and it can literally be the two of us, but it could also be someone in a third world country. The next thing that you will be thinking about is, hey, and now I'm holding these kind of digital dollars on a blockchain. What's the next thing that I can do with it? And whenever you have capital sitting idle somewhere, there will be the need to actually make those stable coins productive. And I think there's a huge opportunity here to tap into that market.
In 5 years from now, do you expect most stablecoin products to be governed by transparent on-chain vaults, or will some of the opacity of TradFi creep back in?
I think it will be a combination of both. We see it already. So with vaults basically being ETFs 2.0, we see more and more that traditional asset managers are entering the space and see the opportunity there. I think it will really be a combination. However, I would tend to think that the crypto native risk curators will have a better scalability just because of the competence that they've built in the last couple of years. And I think that traditional asset managers will have a hard time. However, on the other side, traditional asset managers, for example, get the distribution already, or like traditional retail brokers, if they were to enter the space and wanted to do the risk curation themselves instead of teaming up with the risk curator, they got the end client already. So they might be able to actually pull in more deposits themselves. So I think it will be a good competition between crypto native and traditional players going forward, but definitely the market will institutionalize and mature a lot.
Where can people go to explore Steakhouse products or maybe contact you?
For sure. So most of the information is actually available on steakhouse.financial, which is our website. If you look for steakhouse.financial/docs, you will find all of the documentation around all of the products we discussed here. Um, And at the point of this podcast being uploaded, we will also have our own front end live, which will be accessible via app.steakhouse.financial, where you can also access products that go beyond our currently offered repo strategies.
This has been a masterclass in real mechanics of stablecoin finance and how thoughtful design can reshape how institutions engage in DeFi. Thanks. Thank you for joining me. And to everyone listening or watching, like, subscribe, or follow both of us and share this episode with someone curious.